Hello and welcome to Commerce GYAN. Now, today we are going to start with our part 8 of the Basics of Accounting series. And in this, we are going to talk about subsidiary books. Now, we have already covered the journal, ledger, and basic, you can say, illustrations on these. Also, we have dealt with a number of complex journal entries to give you some practice about complicated journal entries. Now, before we proceed to the subsidiary books and learning about them, there's a small request that I need to make to you, that just in case you have any questions, any queries, any specific comments about the previous videos, you can add them in the comment section of the videos, so that I know that you are able to understand what is being told in this video. And if you find it useful, do share your comment also, so that in the process of making the videos, I can further on update the things in accordance. Also, for those who have joined in new, we have this particular series in the section of Basics of Accounting playlist. So if you want the previous videos, you can go to that playlist, fine. And also, the new people, the people who have come up new to this particular channel, you can definitely subscribe to this channel, as I'm going to keep updating this particular channel with videos on learning specific subjects of commerce. And at the same time, you will get some detailed practical knowledge also on Commerce GYAN. So let's begin our study for subsidiary books. So what are we going to learn in the section of subsidiary books in this particular part is that what are the subsidiary books that we have, different types that we have, the need of subsidiary books, their importance, and at the same time we are going to learn the formats and different illustrations of subsidiary books like sales books, purchase return book, sales return book. Okay. And there are subsidiary books in the format of cash book also, but cash book, I'm going to make a separate video on that, because there will be a lot of stuff in the same video which I don't want to uh, put in this entire video itself. So there will be a separate video on cash book. So stay up tuned to this particular channel to understand the cash book in detail. Okay. So today we are going to just learn about sales purchase and sales return, purchase return, subsidiary books. So what are these subsidiary books? This is the first thing we need to understand. Now, if you remember when we were writing the journal entries, right? We used to keep writing cash account debit, cash account credit, then sales account debit, sales account credit, purchase account debit, and so on, right? Number of times, if you are writing a journal, a sales account would probably appear 5 times, 6 times in the same journal. Purchase also may appear a number of times. Cash also appears a number of times. So there are repetitive, you can say, entries of certain accounts. So instead of writing repetitive entries, what the people writing accounts derived was that let's write it in a separate book, which is called as a subsidiary book. So subsidiary book is just like, you can say, a journal, but it is subdivided into different books based on the nature of the transaction, and that is the reason we call it subsidiary book. Now, subsidiary books are books of original entry. So, primary entry, whenever the first time the transaction takes place, it is recorded in the journal. We know that. Now, subsidiary books is an extension of the journal. So, naturally, whenever a transaction happens, it is first recorded either in the journal or in the subsidiary book. Fine. So, it is a primary book of entry. Now, from this particular subsidiary book, your transactions are going to get posted into the ledger. So this is not a secondary book, though it may seem like one, because we are doing a summarization kind of an exercise under subsidiary book, but it is not a ledger, right? It is a journal only, but it is like a subdivision of the journal, because repetitive transactions are written directly in the subsidiary books. Fine. So this is the first thing. Now, next part that we need to understand is what is the need? Why do we need these subsidiary books? So basically, if you speak of a subsidiary book, it's more like it saves a lot of time and effort. As I told you that if you keep writing sales account, purchase account 10 times in the journal, it's going to take a lot of effort. Instead, if I club all the transactions of sales in one account and say, okay, sales sales entries will be written one below the other, and I know the total sales for that particular month within a look at that particular book, then it's much more easier. So it's going to save your time and effort, and it's going to give you a specialized access, a quick access to the total of the transactions. Also, suppose it's a big entity, huge entity, then what they do is they will give one particular person the activity of only purchase. Another person is recording only sales, so they will subdivide that particular workload also. So every person is not going to write the entire journal, or one single person is not going to write the journal. It will be divided. So one person A may write only the sales entries, another person B may write the purchase entries, and so on. So it's basically very convenient, very quick, and you can access the records quickly. You can get the information quickly, and at the same time, it's good for a check on frequent basis. So if I want to know what are the sales for that particular month, I just refer to the sales subsidiary book and I get the answer. So that is why you can say that the subsidiary books are required and they are actually useful in accounting. Based on you can say the type of the transaction, the subsidiary books will be divided, right? So here you will find the division. If you see your cash and bank transactions are the first part. Second part is if there are credit transactions. So if it is a cash transaction, it will be recorded in one of the subsidiary book. If it is a credit transaction, it is recorded in either of these four, that is purchase book, sales book, purchase return, or sales return. There are bill transactions. So what is bills? Bills of exchange, as we call it, bills receivable book. So it's related to debtors and creditors. So if there is a bill of exchange drawn, then you will have bills receivable book and bills payable book. And then if nothing, nowhere else the transactions are included, then it goes to the others part, and then it is recorded in what we call as the journal proper. So cash book, if you see cash book, we are going to deal with in the next video. But here I'm just going to tell you that cash book is generally of four types: single column, then there would be a double column cash book, which is also a cash and bank book, both two column cash book as we call it. And then there is a petty cash book. So there would be different types of cash books also. Credit transactions, this is the portion that we are going to talk about today. That is purchase book, sales book, purchase return book, and sales return book. Now remember, if you see this particular heading, it is very clearly given here. It is related to credit transactions. So you have to remember that any subsidiary book which we are talking about today, that is purchase, sales return, and purchase return, will be connected only to credit transactions. So if there is any cash or bank transaction that has happened, it will not take place in this particular subsidiary book. Okay. So let's proceed now to the next part. So now we are going to talk about the purchase book. Purchase book here we are speaking about is naturally it's connected with purchases. So as the name suggests, name is suggesting purchase book. So it is connected with purchases only. Now remember that these purchases are the purchases on credit. That means if a business has bought some goods on credit, that means it is to still make the payment, still not made the payment towards those goods, then that is called as the purchase book. For that purpose, the purchase book will be useful. If it is a cash purchase, if it is paid by a bank, that kind of purchase, it is not recorded in the purchase book. So this is a very key important point to remember in recording transactions in the purchase book, which is the first subsidiary book that we are talking about. Now, another important thing to remember is that sometimes business also purchases fixed assets, like you buy machinery, you may be buying some kind of assets like fixed assets, land, building, printing, printer you're buying, laptop you're buying, computers you're buying. So it could be n number of fixed assets that you buy, and sometimes if you don't need them, you may also sell it, right? So in this case, we are not talking about fixed assets. We are not going to record the fixed assets in the purchase book, because purchase book is connected only to the goods which are bought for the purpose of sale ahead. Fine. So that is very important to remember. Two key points. Again, I'm repeating. One is you have to record only credit purchases. And second key point is you don't have to record the fixed asset purchase. Fine. So this is two things to remember. So what is the format now of this purchase book then? If you see here, you have date, you have name of supplier, you have inward invoice number, ledger folio and amount. So date, obviously date is there. Name of supplier means the person from whom you're buying the product on credit. Inward invoice number. Inward means basically it's showing the case of purchase. So inward. Invoice number means basically we are talking about the purchases bill which will be given to you when you buy, and there will be a number written on it which you write here. Ledger folio would be if you are posting from the purchase book into the ledger, you will have a page number of the ledger here and you write down the page number of ledger in the ledger folio. And amount in rupees has to be written in accordance. So this is how you are going to write the purchase book. Now, next part is we are talking about is purchase return book. Just like we have purchases, we also have a return book. Sometimes the goods may turn out to be defective. We don't want them. There is some quality issue. Whatever the reason may be, you may have to return the goods that you have bought. So when you return the goods back, you have to record them, isn't it? You can't just ignore that I have returned the goods and I don't take care of the payment that has to be reimbursed. So I have to record the purchase returns. And that is the reason if there are frequent purchases, frequent purchase returns, then what I do, I make a separate journal which is called as the purchase return book or purchase return subsidiary book. And in this, I'm going to record every single transaction of purchase return if and only if it is done in terms of purchases made on credit. So if you had made some purchases on cash basis and then you say I'm going to record those transactions in purchase return book, no. You can record only those transactions which are on credit basis. So again here we are talking about credit purchase returns. Fine. And what is prepared for this purchase return? Purchase return is based on the debit note. So whenever you buy the goods, what are you doing? You are creating a creditor. You're going to say purchases account debit to the creditor's name, right? Whoever you have bought from. Now that is the reason his account is credited in your books. Now when you reverse that transaction, what happens? You will have to debit his account, and so what do you issue? You issue what is called as a debit note. Clear? So that is how you have a purchase return book. Now here we have the format of the purchase return book. It's similar to the purchases book: date, name of supplier, debit note number, ledger folio and amount. The only difference here is instead of the invoice number, inward invoice number, we are writing debit note number. So whenever you prepare a debit note, you have given that debit note a number, and so you have to record that particular number in this particular column of debit note number. Fine. Now, just like we had purchases, we have also sales, right? So we keep making sales for that particular organization. A business makes sales. Now, sales are always done on two ways. One is cash sales, that is immediate receipt of that particular amount. And second part would be your credit sales. So what are we talking about here is basically only credit transactions. So the subsidiary books that we are talking about here are recording only transactions that are made on credit. So sales book, the sales subsidiary book that I'm talking about here is also recording transactions which are made on credit. So it's nothing to do with the cash transactions. Also, just like purchases, we don't record the fixed asset purchase. In sales book also, we don't record the fixed asset sales. So no matter what that asset is, if it is not a good for, it's not goods, it's not the stock which is being sold out by the business, it is called as a it is not going to be recorded in the sales book. So fixed asset sales are not to be recorded in the sales book. Next is you have to record the transactions in only record the transactions connected to the business goods. So that's what I told you, that you don't have to record the fixed assets. Fine. So now what is the format of the sales book? The sales book has a similar format to the purchase book, here we have date. Instead of name of supplier, here you have the name of the customer. So the person whom you are selling the goods on credit. Then we have outward invoice number. Now you may issue the goods, when you're selling the goods, you will have a basic, you can say, invoice number against your sales that you're making, and this invoice number will be the outward invoice number that you mention here. Then we have ledger folio, and finally we have the amount column. Now comes the last subsidiary book for the day that we are learning is the sales return book. So sales return book, what does it speak of? It's basically again the transactions which are recorded on credit. Now here the transactions are basically what they're happening. It's basically on credit. So if you had made some sales on credit and now you think that the customer wants to return it. So the customer has found some defect, he doesn't want that, or maybe he's bought some extra quantity which you are willing to take back. So any reason could be there why you have a sales return. And so the goods sold that have gone out of your business now are coming back. So in this case, what happens to the customer's account? Is the customer's account going to be debited or is it going to be credited? When you sell the goods, the customer's account is debited, right? We say ABC debit to sales. Now when ABC is returning the goods, what happens to ABC account? You will say sales return account is debit to ABC account. So ABC's account is going to be credited. So credit means here what note or basically you're preparing is the credit note. So whenever you have a sales return happening, what you prepare is the credit note. And specifically just like invoices, you will have a credit note series, numbers will be there and this will be written. Okay. So sales return book is for the purpose of credit sales which are returned. And secondly, important thing that you do here is sales return, you will issue a credit note. Fine. So that is what we have spoken of here in the sales return. Now let's see what is the format of the sales return. So here you can see the format. You have date, name of customer, credit note number, ledger folio and amount. It's very simple. One format you learn, only thing you have to alter the customer or supplier, and here if it is note, it would be depending on what type of subsidiary book you're writing. Depending on that, we have debit note number, credit note number, inward invoice number, outward invoice number, whatever the case is, right? So that's the end of the theory part of subsidiary books. Now what we're going to do is we're going to take a simple illustration demonstrating how you record the transactions in the subsidiary book. So all these four subsidiary books that we have learned, sales book, purchase return and sales return. This is what we are going to prepare in the illustration. So let's proceed. We are going to take into consideration this particular illustrations, the questions on subsidiary book. This particular question is given to you in the description box of this video. You will get a link where you can download the PDF of this question. So what is this question about? It is saying record the following transactions in the purchase book, sales book, purchase return book and sales return book of Jyotiba Enterprises for the month of June 23. So each transaction, we are going to look at it carefully, whether it's purchases, sales, purchase return or sales return, and accordingly we will record it. Two key points is, one is only credit transactions will be recorded, and second, asset purchases or sales will not be recorded. So let's go to the first transaction. What is the first? On June 23, on 1st of June, it is saying Jimmy invoiced goods of 10,000 at 10% trade discount. Okay. So your trade discount is given and invoice number 53 is given. Jimmy is invoicing goods, meaning we are buying goods. Jyotiba Enterprises is buying goods from Jimmy. Jimmy has invoiced. That means who raised the invoice? Jimmy. So if Jimmy is raising the invoice for Jimmy, these are the sales, and for Jyotiba, these are the purchases. Okay. So in Jyotiba, in the books of Jyotiba Enterprises, let us write these four subsidiary books which we have. So these are the formats of the subsidiary books, and on top I'm going to write in the books of Jyotiba Enterprises. In the books of Jyotiba Enterprises. Now, first one is purchase. June, we are writing the transaction, June 2023. On 1st of June, what is the name of the supplier? The supplier's name is Jimmy. Now, inward invoice number is 53 they have given us, right? And he is giving us at trade discount 10%. So, we will have the amount of 10,000 minus 1,000, which is 10% of this. So 9,000 is our total amount of purchase. So we will record directly this amount of 9,000 and not 10,000 or anything else. So let us write here 9,000. Fine. So this is the first transaction. Second transaction is saying laptop purchased 80,000 from Kunal Traders. Invoice number is 12L. Now, if you can see here, it is mentioning laptop is purchased. Laptop is a fixed asset. And as we know that in the subsidiary books of sale, purchase, etc., we are not going to record the laptop. So, in our sales or purchases, laptop or any fixed assets will not be recorded. So, transaction 2 will not be recorded. On 4th, invoiced goods to Madhukar and Company of 1 lakh at 15% trade discount. Now, very important to remember, we are saying invoiced goods. When I say invoiced goods, what is the meaning? Invoiced means Jyotiba Enterprises is invoicing, is raising an invoice, and basically it relates to sales. Now, there is nothing mentioned about whether Madhukar and Company has made the payment. Is there any cash discount given? Nothing. So basically Madhukar and Company is the customer and we are making sales on credit against invoice number 32. So let's record this Madhukar and Company on 4th in the sales book. So in the sales book, June 23, on 4th, I guess it is, right? 4th of June, the transaction is Madhukar and Company, customer's name. What is the invoice number that we are raising? Invoice number is 32. So I write here outward invoice number is 32. And amount that we are basically going to receive from Madhukar and Company will be after the trade discount of 15,000. So I'm going to have 1 lakh rupees of sales minus 15%, meaning 15,000 of the trade discount. So naturally, I am going to get the amount of 85,000. So 85,000 will be the sales made to Madhukar and Company. So let's write here 85,000. Now next is goods purchased on 5th. We are saying goods purchased from Prakash 1 lakh rupees. Invoice number is 201. So go to the purchase book again. Purchase book I'm going to write on 5th Prakash's account. So Prakash, you can also write here A/C to denote that you are writing an account. Okay. So Prakash's account, and what is the number? 201. So 201, amount is 1 lakh. Fine. So that is the entry made of 5th of June. Next one is on 8th. 8th we are saying sold goods to Manju. Invoice number is 33 and amount is 20,000. So this is clearly a sales entry and we have to show it in the subsidiary book of sales. So 8th I'm going to write in the sales book. 8th. The name is Manju. Invoice number, if you can see here, it has to be in series unless and until there was some cash invoice in between. So amount of sales to Manju is 20,000. I record here 20,000 rupees. Fine. So that's the end of the transaction on 8th. Now 9th, we are saying returned goods to Jimmy to 2000 gross and issued debit note number 1. Jimmy is basically connected to purchases. So what will this return amount to? Return of purchases, meaning it should be the purchase return amount. Now remember, this amount is gross. So I need to calculate the net amount. 2000 is the gross amount less 10% is trade discount. So 200 will be the trade discount. So 1800 will be the amount of return of goods in the net value. So I don't record 2000 because it is gross amount. I will record the amount of 1800. So on 9th of June 2023, in the purchase return book on 9th of June, I'm going to write Jimmy and debit note number is 1 and amount is 1800. Right? Amount is 1800. Debit note 1, 1800. Next one is purchased printer. Okay, on 12th, we are buying printer for office use from Prakash and Company and invoice number is 84. Should you record this transaction? The answer is no, because it is a fixed asset, right? So this particular transactions will not find any place here. So purchase printer 12th, we are not going to record this transaction as this is the transaction of an asset. Clear? So that ends 12th transaction. Go to the 18th one now. 18th one, we are seeing sold goods worth 80,000 at the rate of 10% cash discount to Mangesh and Company. Now the answer here also will be that we don't record this transaction. Now you'll say, why shouldn't I record? The reason, because here it's clearly saying 10% cash discount was given to Mangesh and Company. When do you give a cash discount? Based on our previous videos, you must have come to know now that cash discount is given only when the payment is made. So naturally, Mangesh and Company must have made the payment to us, and that's the reason this 10% discount is given. So we don't record this cash transaction also on 18th. Fine. So that's done. Now go to the last transaction, 25th. They are saying Manju found our goods defective and hence returned them. Amount was 2000 gross. Issued a credit note of rupee 1. Now, since it is a gross amount, 2000 rupees less trade discount. What is any trade discount is here? No. Sold goods to Manju, invoice number 33, amount of 20,000. So there's no gross and net actually, because we are not giving any kind of trade discount or cash discount here in this case. So basically, Manju's account 2000, we just have to write in a sales return book. So let's go to the sales return book now. In the sales return book, June 2023, date that we are having is 25th, and Manju is the name of the customer who's returning. Credit note number 1 and amount returned is 2000. Got it? So there is nothing like gross and net in this case because there is no question of discount. If there was discount, then we would have taken the net amount. Here there's no discount. So we have recorded all the transactions now, whatever were connected in this particular illustration. Now that doesn't end the matter. What we are supposed to do is we have to close these accounts by taking a grand total of the month. So I just write here total or grand total, whatever you like, 2000. Same way, we are going to take the total of all the subsidiary books. Purchase return book also, I'm going to take the total 1800, and this I write here total. Here also purchase book and sales book, I'm going to write the total. See here, if you notice, I'm talking about the heading as purchase book. and not purchase account. Okay, it is not a ledger, it is a purchase book. So 1,09,000 is the total of our purchases for the month of June. So in the purchase book, I take the total. Sales book, now I have sales book also, I take the total. Sales book total comes to 1,05,000. Fine. So this is the end of the illustration. This is how you write the purchase book, sales book, purchase return, and the sales return book. So format is known. The two important things to understand is credit transactions are recorded and no fixed asset transaction is recorded. These are two important points to remember whenever you prepare the subsidiary books. Fine. So hopefully you have understood all the subsidiary books, the four subsidiary books that we discussed: sales book, purchase return, and sales return book. The next subsidiary book which we are going to learn is the cash book, but this we are going to learn in the next upcoming video series. So let me know how you found this particular video. Was it useful to you in the comment section? Also do share this video to all your friends and people who would like to learn about accounting and the other aspects of commerce. So hope to see you in the next part of this particular video series, part 9, where we are going to learn the cash book. Thank you.